Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 274 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, Nick Whitaker, our Director of Research and Trading, is filling in for Matt this week. So Nick, thanks for doing this and welcome back.
Yes, of course. Always good to be here and excited to dig into some content for listeners and viewers.
Yeah, for sure. But before we get into that, as always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on October 23rd. S&P 500 index up 0.6% for the month and up 21.5% for the year. The Dow Jones Industrial Average up 0.4% for the month and up 12.8% for the year. The NASDAQ Composite Index up 0.5% for the month and up 21.8% for the year. The Russell 2000 Small Cap Index down 0.7% for the month and up 9.2% for the year. And the Vanguard All World X United States ETF down 3.6% for the month and up 8.2% for the year. 3-month Treasury rate at 4.73%, the 2-year Treasury rate at 4.07%, and the 10-year Treasury rate sitting at 4.24%. Moving on to big headlines, current events from the week. Nick, the only really thing that I have is, we're kind of getting right into the heart of earnings season, where publicly traded companies have to report their financial results for Q3 of 2024. This earnings season got kicked off with the major banks, which reported relatively strong financial results for the most part last week. But it's going to be pretty busy in terms of reporting over the next 2 weeks. It's really going to start to pick up. You're going to have a lot of your heavyweight mega cap tech names report next week.
The big guys,
which is kind of interesting how this is all, playing together. Is you have earnings reports for some of the most important companies in the world, and the following week you have the presidential election, right? Yeah. So there is a possibility of, this volatility storm that we usually see, separately during a presidential election and with earnings season, but the two events combined together could be for make for an interesting couple of weeks here. So. Yeah. Only other news is that I believe the IRS came out with 2025 inflation adjustments for tax rates, things like 401k, IRA contributions, what those maximum limits are. I know Taylor is going to touch later on the show today in the financial planning topic of the week, some of the changes coming in 2025, but most likely next week or the week after, we will dig into what tax rates and brackets are going to be for next year, and max contribution limits will be as well. So that will be coming shortly. Tweets, articles, and research from this week. First thing I had, Nick, was a tweet from Steve Deppe, who's a CMT. Jenna will throw up this graphic on the YouTube page for those watching. It's kind of a busy graphic here, Nick, but essentially what it is, it's an Excel spreadsheet. And Steve says, this is random yet interesting. When the S&P 500 ends the month of October with trailing 6-month returns of 10% or more, the remaining 2 months of the year have never closed lower, i.e. December's monthly close was never below October's monthly close. Average returns over the final 2 months have been huge. With huge, the Donald Trump huge. Yeah.
Huge.
But again, this is kind of a busy graphic, but I think the most important thing that at least I took out of this, and that listeners and viewers should take out of this, is that when stocks have a strong start to the year, or the last 6 months through October, the last 2 months of the year tend to be very positive for stocks, with the S&P 500 averaging 7.38% over the final 2 months of the year, which is very, very strong for a 2-month period for stocks. So again, we've talked ad nauseum about how strong the fourth quarter usually is for stocks, that the strongest period out of the year is usually October through April. So this is just another feather in the cap that shows when performance has been really strong through October, that the final 2 months of the year could be even better. And I know that we went over the year-to-date performance numbers for the major indices that we track, and some people may be like, well, you know, S&P 500 is up 20% already this year, so it can't go that much higher. And I think it definitely can, and there's a strong possibility of that could happen. So just wanted to throw that out there. We've mentioned Steve's work before. He does some really good, interesting calculations in Excel. So more data for the bulls moving forward.
Yeah, absolutely. And just another kind of reminder, and we've talked about it many a times, but Q4, one of the reasons that we historically see strength in Q4 is, the holiday season and increase in spending, particularly around, Christmas, and companies benefit from that. We're a consumer-led economy, as we talk about all the time. So that's another kind of piece of this as well to just think about.
Yeah, for sure. Second thing I had was a blog post from Ryan Dietrich on October 16th titled "Why There Could Be Years Left to This Bull Market." So the first graphic that Jenna is going to put up on the screen shows bull markets for the S&P 500 going all the way back to 1950. And again, I talked about this briefly on a few podcast episodes ago with Matt. Bull market is defined as a market climbing 20% from a recent low. So again, going back all the way to 1950, the average bull market has lasted 5.5 years. And there was only one period where bull markets didn't make it to 2 years in length. So we're at the 2-year mark right now, Nick. Again, data and history shows that there could be some room to run here. Matt talked about this a few weeks ago as well. But, relatively speaking, we still are in the early innings relative to history, even though it might not feel like it because just returns over the past year or two have been so strong. But not to get too much on my riding my bull, no pun intended. The second chart that Jenna is going to throw up kind of brings us back down to earth here. And Ryan pretty much here is showing the performance, every year of the bull market from year 1 all the way up to year 13. And typically year 3 stocks see some below average returns during all the years in a bull market, right? So for year 3s of a bull market, S&P 500 averages up 2.1%. So we're just going into that, we're going to be embarking on that 3rd year here. So just want to tame expectations that even though we still might have a lot of room to run to the upside, year 3 tends to be tougher than normal for stocks. So I don't think it's any secret that over the past really 13, 14, 15 years, Nick, stocks have performed above average, going back to the market's inception. And we know that average return can't stay that high for that long, right? So depending on where you take the data from and what year you start from, stocks do anywhere between 6.5% to 9% per year, again, depending on when you choose your starting date with your data. Yeah. And over the past several years, it's been much higher than that, right? So year 3s tend to be up just about 2.1% for stocks in bull markets. So while it might not be doom and gloom, it might not be continuing to have, 15, 20% return years over the next couple of years, especially in year 3 of this bull market.
Yeah, 2 things I'll add there. On the first chart, Again, reminding listeners that the average bull market was about five years. 5.5 is the average. And there was only one period that was under 2, and that was 2020 to 2022. And the point I'll make there is the violent swing in the economy, and we've talked about that all the time. The dip and the increase and just the change to the supply chain. I don't think we've seen anything like that in history. So that's probably one of the main reasons why that was such a short bull market. And then the second chart, I think that makes a lot of sense, thinking about, okay, if we're going to take that average of 5 years, why would the third year historically be a little weaker? And it's probably because of the exuberance once you come out of a bear market into the bull market. That first year, and that's going to bleed into the second year, people are flooding the stocks, right? Because you're changing in your cycle, you're getting ahead of the cycle. So it makes sense that year one's going to be strong. You're in the midst of a major rotation, and how that could carry into year 2. And then year 3, the market says, okay, let's pause. Let's get our ducks in a row. Let's make sure we're not overbuying things. Let's make sure these balance sheets and these earnings still make sense with the global economy. Where are we in the cycle? So I think time-wise with those two charts makes a lot of sense to me.
Yeah, for sure. I mean, just look at year 1 of bull markets. The average is 36%,
yeah.
right? Which isn't sustainable.
Right? Yeah.
And year 2 is 15%, and then year 3 is 2.1%, and year 4 jumps right back up to almost 15%. So again, kind of goes back to, we can quote average returns of stocks all day long, but it's very rare for us to have a year where stocks actually do between like 7 and 9% per
average
year, right? Yeah. It's either like way above, way below. So thought that this was an interesting piece. So we'll have that link to that full article from Ryan in our show notes if you want to check that out at some point later in time. Last thing I had, Nick, was the most recent Economist magazine cover. So we've talked about this before. There's such thing in our industry known as the magazine cover indicator. And once something makes it to the front page of economic magazines such as The Economist, I start to worry that if they're touting something that is going to end. And this is quite an interesting one. The cover page shows a bundle of US dollars taking off like a rocket ship, and it says, "The Envy of the World, America's Economy, a Special Report." And Jenna will throw this up on the YouTube page. This will also be in our show notes. But to me, Nick, the way I read this is that some journalists that maybe aren't totally in our industry are just somehow taking notice that the American economy and the stock market have been far outpacing the rest of the world. And just as a newsflash, this has been going on for more than a decade. So hopefully this doesn't spell, doom and gloom or recessionary environment over the next 10 years, because if we look back at the past, The Economist has done a pretty good job at spelling the end of trends with front covers like this. So just thought that it was interesting. Again, by no means does this say that American stocks are going to underperform international stocks over the next couple of years, but at some point we do expect that to revert to the mean, because it really has been over a decade of outperformance for U.S. equities. And I won't really go too much further because I think you have a piece on this in a little bit.
I do, yeah.
But there will be a point where international stocks, emerging market stocks do outperform the U.S., and that'll require shifts in people's portfolios. And people won't be used to that when that happens, because there's just been such a long period of time where it hasn't made sense to have such a large weighting in international equities. So it might be a little uncomfortable for people at first when that happens, but still we haven't seen any signs of that changing. And I just hope that this doesn't mark the end of the U.S.'s reign here from The Economist.
Yeah, I'd be surprised if this did mark the end of the reign. Maybe this is probably more of a journalistic investigation as to perhaps why the American economy is so resilient. And it's just to clarify on likely, I've read this specific Economist, but the American economy is, of course, strong and has incredible resilience going back, a long time in history. And it's not necessarily that our GDP growth is percentage-wise like way bigger than some other countries. I think where some of the strengths come in is how big we are, combined with the fact that we can still put up pretty consistent GDP growth, and the swings aren't as massive as like a developing nation, or even some developed nations where the percentage swings of GDP will be greater than ours often. And I think that's where our resilience really lies, is our ability to just stay steady Eddie, but especially being so big as well. So that's kind of my only things to add there.
No, that's a good point. It's it's a spending economy, and as we've talked about before, even with everything going on in the world, the consumer just has continued to spend, which is been a good thing for publicly traded stocks, especially ones that are based here and headquartered here in the U.S. And we have, I think the other easy answer is that we have some of the best, most powerful company in the world. Here. So that's the simplistic answer.
But it's a good answer.
But it's it's a good one, right?
It might be a simple answer, but it's a good answer.
Yeah, and there's always gonna be this natural domestic equity overweight, I think, in most people's portfolios, because they kind of have an idea of what they're holding. They might not know like any company that's based out of Japan, for example. Obviously the car companies, right? But some smaller online e-commerce name in China or Japan, people might not be comfortable with that, right? So as long as people have this overweight in U.S. stocks, it's hard to see when this outperformance is going to end. But it will eventually. Just don't know when, but we'll be ready for it when it does.
Indeed.
I will turn it over to you.
Yeah, the first thing I have for listeners is a couple articles. You're going to get a couple 2-for-1s from me here. The title I'm going to call this is "There Are Always Opinions on Both Sides." And there are 2 articles, and these articles both came from Bloomberg and were released on the same day, 10/21. The first one says the decade of big S&P 500 gains is over, and that's according to Goldman Sachs strategists. Goldman Sachs strategists are, upper echelon, bulge bracket, big wigs in the financial industry. The strategist said the following: the S&P 500 index is expected to post annual nominal total return of just 3% over the next 10 years, according to an analysis by strategists including David Costin. That compares with 13% over the last decade. I also see roughly a 72% chance that the benchmark index will trail treasuries, and a 33% likelihood that they'll lag inflation. Still, this year's 23% bounce has been concentrated in a handful of big tech companies. Goldman Sachs strategists say they expect returns to broaden out and the equal-weighted S&P to outperform the market-weighted S&P in the next decade. So,
kind of alludes to what we were just talking about earlier. But I think the one thing I want to point out here, Nick, is that I have heard this for 6 years in a row now, that forward returns of U.S. stocks are going to be sub 3%. And it just hasn't happened.
And we're up 24%.
Exactly. So again, it's just, take this stuff with a grain of salt for what it's worth. Like you said, Goldman strategists are usually held in pretty high regard. But that doesn't mean that you should take every word they say as biblical, right?
Exactly.
literally, I have heard this for so many years in a row where when I hear this stuff anymore, I kind of just brush it off. I'm like, huh?
Yeah, we'll see.
Again, it's another one of those things that eventually it's going to happen, but it's not happening yet. And no one, regardless of how smart they are, or if they can predict the future, or, see things through the universe, they cannot predict what stock returns are going to be over the next several years. It's not possible. So I struggle with this one. And I just want people to be careful about, reading too much into this type of stuff.
It's okay, because that's why we have the opinion on the other side. Right. So, and to point out that, again, these strategists are saying, over the next 10 years, they expect the U.S. stocks to be weaker and to see some rotation into bonds, and bonds might outperform, et cetera. On the other side, same day, Carson Block says, close your eyes and buy big U.S. stocks. Now, what's interesting about this is Carson Block is a famous short seller, particularly in Chinese markets, but a short seller is someone who bets that the stock is going to go down. So they make money by basically selling the stock, and then the stock falls in value, and that's how they make down. They're pessimists, right? They're betting against stocks. And Carson Block is a famous one to do that, famous short seller. That's kind of how he's made his career, is being a pessimist. And this pessimist says, let's see, most investors would do better to just buy the biggest U.S. stocks, as steady inflows will push the markets ever higher. While there are concerns over valuation of the S&P 500, repeatedly hitting new highs, the Muddy Waters Capital founder said inflows from retirement funds will stay a key driver for further gains, especially in the most heavily weighted names. He says, it probably pays not to think too much, just close your eyes and probably buy the Magnificent Seven. Then he says, this is an interesting thing. Then he says, in the past few years, I've looked back on my career as an activist short seller and done the math and felt like I probably should have just been long the S&P 500. So
it's pretty funny.
There's always opinions on both sides. Don't take even great researchers, and all of these guys that I've mentioned in these articles are, they're very talented, they're very smart people, and they have very different opinions, and that's okay.
And just for the record, I also don't recommend just closing your eyes and blindly buying big U.S. stocks, but he makes a good point. I mean, there's so much money from retirement accounts coming into the market every single week, every single month, every single year. Yeah. And that's not going to stop for the most part. I mean, I know there's going to be points at which people pause their retirement accounts because they have something else going on in their life that they need more money for. But these automatic contributions aren't going to stop. And that, I think, provides some sort of a backstop against how weak the market can be.
Over a long period
of time. And maybe that's something that we haven't talked about that has contributed to the market strength over the past decade and a half. Because if you think back, Nick, to 70s, 80s, 90s, early 2000s, most retirement plans for corporations were pension driven, right? It wasn't until just a couple decades ago where the 401k really blew up, and maybe, I don't know, I'm just speculating. Maybe that's one reason why markets have been more steady over the past decade and a half, is because these corporations have moved away from the pension plans towards the 401k plans, where you have money coming into the market all the time. So, just
definitely a piece of it.
Just a speculation, but I think that's going to provide some sort of backstop as long as 401ks remain the preferred retirement plan for employers.
Yeah, absolutely. So in 10 years, we'll put a pen in this podcast. We'll come back. We'll review these articles. We'll see who was right, Muddy Waters or Goldman Sachs.
When I'm 70, it'd be fun to come back to this one.
Yeah. The last one I have here, because that was kind of a 2-for-1 there, is like you mentioned, U.S. equities still lead the world. This is research from Charlie Bolello on 10/22. It says the following: U.S. equities continue to outpace the rest of the world, a trend that has persisted over 16 years. This is by far the longest period of U.S. outperformance in history. And then we'll throw the chart up here, and the chart kind of speaks for itself. I don't need to say too much, but 16 years of outperformance, at some point, like you mentioned earlier, we will see a reversion to this trend. No one can tell you exactly when that's going to be or how violent it'll be or gradual, or maybe it'll just kind of chop sideways for a few years. But it's something that we watch pretty closely, and the economic underlying strength of the world and the U.S. is a big factor in this. And that kind of goes back to what we were talking about with your Economist point of view is, as long as the U.S. economy continues to stay strong, relative performance has a chance to continue. Relative outperformance, I should say, has a chance to continue. It's where the U.S. is contracting and maybe, economically we have a shock, but the rest of the world isn't as impacted. That's where I think we'll see that rotation, and we just haven't seen it yet for a very long time.
Right. And for people that are newer to the markets, I mean, if you take a look at this chart from, for 10 years from, the late 90s to, 2008, 2009, international stocks dominated U.S. stocks in terms of performance. So, at least, since I've been in the industry and you've been in the industry, U.S. stocks have been the place to be. But like we said earlier, that'll change at some time. And there's a little bit of a head fake there in like 2021 and 2022 where people are like, oh, here it is. The next decade, it's going to be international stocks load up. And you can quickly see that was quite the V-shaped recovery in relative performance of U.S. versus international. So, very interesting. It's lasted 16 years. It could last another 5 years, and I wouldn't be surprised.
Yeah, not at all. I would not be surprised about that. Just given everything that we know, particularly in the developed economies outside of the U.S., I'm thinking Eurozone, Japan. That's where my mind goes. And when I think about their economies and what's going on, I still favor the U.S. right now.
Yeah, for sure. Well, thanks for joining us, Nick. Your thoughts are always valued and appreciated here. So thanks for sharing what you had with listeners, and looking forward to having you back another time.
Absolutely. Thanks as always, and I hope everyone has a nice week.
Taylor is going to hop in here really quick to talk about the financial planning topic of the week, and she's going to talk about 5 changes coming to IRAs and 401ks in 2025. This is from an article in Kiplinger by Donna Lee Valley. So Taylor, you can take it away.
Yeah, so like you said earlier, a lot of the inflation adjustments were just released, but I think a couple of the topics on here today are pretty interesting and will affect, obviously everybody who participates in a 401k or IRA. So the first change has to do with catch-up contributions to a 401k. So right now in 2024, once you reach the age of 50, you are allowed to do an additional $7,500 on top of the $23,000 limit into your 401k. But starting in 2025, an additional catch-up contribution was added for people between the ages of 60 to 63. So now once you reach age 60, that catch-up contribution increases to the greater of $10,000 or 150% of the 2024 catch-up contribution limit, whichever one is greater. So I think this is a great addition for people who are, really close to that retirement age, obviously, just allowing them to save a little bit more for those final working years.
Yeah, it makes sense. Kind of just like supercharging the 401k before almost being eligible for Medicare, right? Because that's a big thing that keeps people working, is having to pay for health insurance on their own without being covered by their employer until they're eligible for Medicare at 65. So I think this will be helpful and might bait people into working a couple more years, because they're like, I'm just going to sock away, an extra $30,000 for the next 2 or 3 years before I retire. So.
Yeah, exactly. And one other important note for this is that to take advantage of this catch-up, if you're 63 years old by the end of the year, you can't participate in that additional 10,000 or 150%, whichever one's greater. So it's really for a smaller, age group.
Right. Okay. Well, I'm sure that's something that isn't going to be broadcasted too much. So I'm glad that you brought it up here.
Yeah, and in addition to catch-up contributions, something similar is also happening for simple IRAs. So with the simple IRA, again, once you reach age 50, you are allowed a catch-up of about $3,500. But next year, again, once you reach age 60, that will increase to the greater of $5,000 or 150% of the prior year catch-up limit. So simple IRAs are also going to be changed for that.
Yeah, and simple IRAs definitely less common, but they're for smaller employees or employers. We typically see this because the costs are a little bit cheaper than having a full-fledged 401k plan. So if you do work for a small business, simple IRAs are pretty common. But if you're working for a larger corporation, you're typically not going to have this.
Yeah, typically see the 401ks with the larger corporations. But another change, and this one I think is pretty interesting. This article refers to it just as the automatic 401k enrollment. So this automatic 401k enrollment is for people who just don't elect to put anything in the 401k and, you're newly hired on. So if you're not electing anything, you're automatically enrolled at a contribution rate of at least 3%. And then as long as you don't make any changes to that election, every year going forward, that amount is increased by 1% until it caps out at about 10%.
Okay.
So obviously, if you're not wanting to participate, you can change that and opt out of it. But I think this is great for people who maybe just don't understand retirement accounts, don't know, what to put or don't sign up, but they're actually already contributing to their retirement.
Right. Yeah. And this is something that, we've talked about because we've worked with, larger employers and helped them manage their 401k plans and meet with participants. And I remember vividly meeting with this one guy that, he was getting close to retirement age and he started working at this company, when he was like 20 years old. And he was like, when I started, I just put 12% in my 401k right off the bat because my manager told me to do it. So I didn't really look at it until a couple of years ago. And now I have, a couple $1 million in there. And he was like, if I didn't talk to my manager and he didn't tell me to put in 12%, I wouldn't be able to retire now. Right. And I think, having people start off at some sort of contribution makes sense because they're not going to know any different. If you're right off the bat, first job you have are contributing 3% to your 401k, you're only going to know what your net pay is from that point on. Right. So you're not going to miss it. But I understand life happens and sometimes you're going to have to lower that or get rid of the 401k contribution for a couple months or a year to save for something else. I understand that. But it's a lot easier to start off contributing something than waiting a couple of years and then trying to make the decision of how much you should be contributing. So I personally think the automatic 401k enrollment is a good thing.
Mm-hmm. Yeah, and I'm glad that they're doing that automatic, 1% increase with it too, because people normally get cost of living adjustments every year, and then you're really not going to notice that you're putting in more, like you just said.
Right.
The last change for 2025 that this article highlighted was the changes for the inherited IRAs, which I know we've talked about before on the podcast, but I do think it's very important. So did want to just touch base on it again. So just as a reminder, if you have an inherited IRA from somebody who passed away on or after January 1st, 2020, you are required to withdraw all the funds in the IRA no later than December 31st of the 10th full calendar year from the passing of the original owner. But starting next year in 2025, those inherited IRA owners will have RMDs, or required minimum distributions, every year until that 10th year, and it's completely depleted.
Yeah, so that's a big one. And when these rules first changed, I'm not gonna put a blanket statement out there, but most of the time we were encouraging clients to say, hey, you should really consider taking some amount out each year up until that 10th year, so that you're not hit with a large tax bill at the end of that 10-year period. Because if you inherited an IRA that is 100% pre-tax, and let's say you inherit it at $100,000, and that balance over the next 10 years grows to $200,000. And if you're forced to take that money out at the end of the 10th year, in the eyes of the IRS, that's $200,000 of taxable income to you in that year, right? In addition to what you're making from your current job as 1099 or W-2, right? Which would be tough to swallow that big of a tax bill, right? So we've kind of been recommending this for clients, even though they don't necessarily need to by law. However, obviously there's exceptions for this case. So can you talk about the exceptions of people that don't necessarily need to deplete the account at the end of the 10-year period?
Yeah, so the exceptions to this rule would be surviving spouses. So surviving spouses can typically just move that IRA into their own IRA, or they can open up an inherited IRA. So they have a little bit of lenience there. A child of the decedent who is under the age of 21, also not subject. A beneficiary who is not more than 10 years younger than the decedent. And then an individual who is disabled or chronically ill is also not subject to these rules.
Right. Yeah. So it's definitely a big change, because, there was a lot of confusion initially in 2020 when the IRS came out with these regulations, because they didn't say anything about required minimum distributions. So everyone was like, do we still need to take RMDs like we have been, if we inherited an IRA prior to January of 2020? So they finally clarified that. And it's important to note, I think, too, that if you did inherit an IRA after January 1st, or I think it's actually from 2021 through 2024, and you haven't been taking RMDs, you're not going to be penalized for that. It's just starting in 2025, correct?
Correct. Yeah, but in the future, if you don't take those RMDs that start up in 2025, the penalty is about 25%. So definitely don't want to miss a withdrawal.
Right, exactly. And if you're working with an advisor, or if you're one of our clients listening with us, our systems will automatically account for this, and this will get captured. But if you're working with another advisor, or you're just self-managing, this is something to definitely be aware of, especially if it's a larger IRA that you inherit. 25% penalty will add up pretty quickly there. So, and not to forget that you're going to have to pay taxes on any distributions there as well, if the money is in a pre-tax IRA. Well, thanks for hopping on with us, Taylor, and explaining those couple of changes in 2025. I personally, this is the first time that I heard of the changes for catch-up contributions for people age 60 to 63. So I think that's a big one. And if anyone has any further questions on any of these details, you can feel free to reach out with us, and Taylor would be more than happy to talk through this a little deeper. Like I said, earnings season is going to continue on here and be pretty heavy over the next couple of weeks before the election. So could have some higher than normal volatility over the next few weeks. But other than that, we will talk with everybody next week on episode 275. And I hope everyone has a great weekend.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.